All right, welcome to this week's episode of Double Line Minutes. I'm Jeff Mayberry with Mark Kimbrough.
Hey, hey.
It's just after 10 a.m. Pacific time here, October 25th. I'm fighting a little bit of a cold this week, so hopefully I'll be quick on that mute button and don't cough in everyone's ear today. But as we were talking about before we started recording, it seems like something's going around here, at least in the Southern California area.
Thanks for making out today.
Yeah. Well, at least I didn't infect you all week, Mark.
Yeah, yeah. Thank you.
All right, with that, let's go with to where are we for the week? And it was a quiet week. Interestingly enough, S&P was down about, or as of recording, it's down about 50 basis points on the week. And normally, when we look at that, we would say the kind of high-flying sectors, tech, communication services, and consumer discretionary, would be driving that and move down. But those are actually the only three sectors that are up on the week. We have tech up about 50 basis points, communication services 20 basis points or so, consumer discretionary up 1%. The other eight remaining sectors are the ones that are down. The big loser looks like materials down 3.5%, healthcare down 2.6, industrials down 2.5, and then your best performer out of those negative sectors looks like energy down about 70 basis points. So kind of a weird reversal from the markets on the week. Month to date, though, the S&P is still up 1.5%, and the big loser on month to date, healthcare down 3, and tech is up 2.8. So really kind of a mixed bag here on the week. We go down to look at the Russell 1000. That's down about 50 basis points. Also, Russell 2000 down 2.3%, and the S&P equal weight down 1.7. So kind of shows you though those kind of high flyers kind of propping up the market, but still down on the week. If we shift our focus over to the bond market, pretty quiet week in bond land. We have the 2-year Treasury up 13 basis points, 10-year Treasury up also 13 basis points. So a parallel move there. The 2 years now at 408, the 10 years at 422. And I guess as you would expect with a parallel move, the 2s10s didn't change and still at a positive 14 basis points. Long bond still the high yield on the curve at 449, so almost that 4.5% on the long bond. That's up 9 basis points on the week. As you would expect with the parallel shift up in interest rates, that's a means for a bad returns for the bond market. Ag's down about 0.75%. The big loser there was agency mortgage-backed securities down almost 1%. Investment grade corporates down 85 basis points or so, and treasuries the best performing sector, but still down 65 basis points. We kind of go out of your traditional bond sectors. High yield was down about 35 basis points. Bank loans with their floating rate exposure didn't no real duration there, up about 16 basis points and up 1% on the month. And then emerging markets actually down 1% on the week. Still looking though year to date, ag up 2.2%, high yield up 7.5, bank loans up 7, EM up 7. So longer term view, as we would expect, given the higher yields we started the year with, that carry that total return is actually helpful there, even though we're down on the week and the month. Shifting finally to the commodity market, the Bloomberg Commodity Index up 2% on the week, so finally a good week there for commodities. Looks like the big winner was energy up 5%. Led by WTI crude oil up four and change percent. Looks like we got a last price there of $71.6 per barrel of WTI crude. Gold
Yeah.
also a big winner, up 90 basis points to 27.36 there. Mark, I don't know if you saw anything else going on in the market, but it seemed like it was a pretty quiet week. Kind of
Yeah,
as I put in the Spaces post here, kind of waiting for next week.
exactly. I mean, we'll see an economic summary and we get into the what to watch for next week. But yeah, there wasn't a lot of catalysts this week. It was just kind of a little election watching. But aside from that, not a lot of market moving events.
Yeah, why don't you get into the minimal amount of macro data that we did get this week?
Yeah. All right. Well, we'll start off with Monday. We have the LEI, the Leading Economic Index, that came out at negative 0.5% on the month, below estimates at negative 0.3. Just a quick reminder, look, this is supposed to try and catch changes in the business cycle. There are two metrics that the LEI uses to try and give a recession signal, something it's signaled for the most part of the last few years, starting back in 2022 when we did have that negative first quarter GDP print. But they have two conditions. The first is a negative 4.4 on the 6-month annualized rate of LEI. We're at negative 5.2, so that condition is checked. and the other is a diffusion index on a 6-month basis below 50, basically saying that more than half of the index components are down on a 6-month basis. That's at 35. So we have a recession signal from this metric. We continue to watch it. We'll see how long it remains in recessionary territory. Moving forward 2 days to Wednesday, you had the Federal Reserve releasing the Beige Book. This is something they release 8 times a year. Just good qualitative color. Give you a quick summary of this, and I'll say that's stable. You had economic activity across the board. It was mostly little changed. A couple districts were up. You had employment broadly being up, prices moderating. So I'd say all in all, a positive Beige Book report as we're heading into reporting our Q3 GDP numbers. Moving forward today to Thursday, we have initial jobless claims for the week ending October 19th. That came in at 227K. That's 15K below estimates and 15K below the prior. I'll just say that it looks like it's starting to settle down post some of the hurricanes, some of the weather-related impacts we had. Looking at like state level data, the largest declines you had week over week were in states that were impacted by Hurricane Helene and Milton. So we did see Florida claims. That was the biggest gainer. It seems like there's the delayed impact or time for people to have to file for their initial claims because of the rough conditions they went through. So it's understandable, but those numbers look like they're starting to settle down. That brings the 4-week moving average up to 239K versus the prior of 237. We also get continuing claims on Thursday for the week ending October 12th. That came in at 1.897 million. That's 22,000 over estimates, 28K over the prior. This is actually like to talk about high watermarks, low watermarks. Here we go. Important data points like this, and this now is at the highest level since November 2021. Again, that'll factor in some of these weather-related claims. Both initial and continuing have actually been impacted by the ongoing ripple effects from the strike going on in the aerospace industry. It's a machinist strike. I think 34,000 people are on strike, and while they don't get to file for claims, the upstream and downstream people that are impacted by their strike do. So, in the coming weeks, hopefully we'll see both these numbers continue to settle out, or I should say maybe continuing claims takes the lead from initial and tries to catch down a little bit. Also on Thursday, we had S&P Global releasing PMI data for U.S. manufacturing services in their composite measure. I'm going to call this kind of steady as she drifts. There's not a lot to dig into here. You have ongoing weakness in manufacturing, ongoing resilience in services. I mean, the print for manufacturing came in at 47.8. Again, these are diffusion indices, so sub 50, we're going to say that's contraction. It's been a contraction for 4 consecutive months. Services came in at 55.3, basically in line with the prior at 55.2. That's been with a 55 handle for 5 straight months. So again, stability in these numbers. Services is strong. Manufacturing, it's limping along. Lastly, let's get to today. Actually, we had durable goods orders come through. The volatile headline number came in at negative 0.8%. Because of the ordering of aircrafts really swinging these numbers, I like to maybe focus more on the year-over-year number for the durable goods orders that came in now at negative 2.9%. This helps reflect kind of the weakness we see in manufacturing. This is all related to that. If you strip out that volatile transportation figure that came in, durable good orders, ex-transportation came in at a month-over-month 0.4% for September. That's versus a prior 0.6, being estimates of negative 0.1. That brings that year-over-year number up to 1.2%. And then finally, we have capital goods orders, non-defense ex-aircraft, both orders and shipments. The orders number came in at 0.5%. It's a firm number, better than the prior 0.3 and better than estimates of 0.1. That year-over-year number, though, is only 0.6%. So again, another little flat number. And lastly, it's the shipments number that's actually fulfilling all of the demand that actually exists. No orders canceled, these things actually being shipped out. That number hits GDP. Its 3-month annualized average is now at negative 2.8%. I'll just stick with that number because that's more important. That'll give you a little lead on Q3 GDP. From a goods, what's the term? Basically from inventory equipment estimate for a GDP. Sorry for that bluster there. But that kind of wraps up your week. I mean, hopefully, a lot of this manufacturing data, there's been a lot of talk of people pulling back because of election uncertainty and high rates. Well, at least one of those things hopefully is going to go away in the next couple of weeks. So, and hopefully the other can follow. So we'll see if that loosens up maybe in the new year. But that wraps up the light week of economic data.
And really, when you look at Fed interest rate expectations, we're still at 95% chance of a hike there in on the November 7th meeting, 84% chance of a hike. I mean, sorry,
The
a
cuts.
cut.
It's still there, man.
I'm
We're
so
still
used to
working
saying
through
hike.
it.
Cut. 25 or 95% chance of a cut in November, 84% chance of a cut in December.
There we go.
And we are, I think blackout period starts tomorrow, so we shouldn't get any more Fed speak for the week for next week. But next week is a pretty busy week there in terms of data as we kind of round out the end of the first month of the quarter. On Tuesday, we get the S&P Core Logic Case-Shiller 20 City Home Price Indices. They are expected to be very strong still. We've seen pretty strong prints for most of the year, and we'll probably continue to see that here. Those are numbers from August, so that should be probably the peak home prices for the year. We also get on Tuesday the JOLTS job openings data. The estimate there is 7.9 million, down from 8.04, and we'll see how things shake out there. I know, Mark, you always like to look at the quits rates and all the underlying numbers, except for the underlying rates as opposed to the actual headline number that people like to report there.
Yeah, you take it all in. They're doing all the work, so I gotta look at it all.
Yeah, always, there's interesting tidbits there sometimes.
Indeed.
On Wednesday, we do get the GDP for the third quarter advance number that comes out, or that's expected to be a 3.0. Certainly doesn't sound like we were in a recession there during the third quarter with that 3.0 number. Man, kind of forecast that it's going to be hard to, fourth quarter, hard to go from three to a negative. So it seems like fourth quarter we should be okay there from a GDP standpoint also. Thursday is a pretty busy day there. We get the employment cost index. That's one of those measures that comes out every quarter that Chair Powell continues to keep an eye on there. It's expected to be 0.9%. So kind of elevated, but not really anything that would kind of force the Fed to continue to keep rates higher to drive inflation down. We also get personal income and personal spending. Both of those expected to be a 0.4 from a 0.2 the prior month. So kind of keep an eye out on those. We also get the PCE price index. Month over month, that's expected to be a 0.2, up from a 0.1 last month. Year over year, that would put it at 2.1, down from 2.2 since we've got a 0.3 rolling off from last year. Core PCE expected to be 0.3, above the 0.1 from last month, but also flat from last year. That would bring the core PCE to a year over year number to 2.6, down from 2.7. So, progress has slowed there on the inflation front, but still trending in the right direction. We'll also get in our busy week, we get obviously the jobless claims again, kind of see where those shake out, whether those, as Mark said, those hurricane numbers and kind of come off the board there. And then finally, Friday, the big day, we'll start later in the day. We get ISM manufacturing. We'll see whether that continues to be below 50, even though it's expected to be 47.6 there. So whether that confirms the S&P Core Logic, or not the Core Logic, the S&P Global manufacturing numbers that Mark just talked about there. And then it is Pizza Friday. We get the change in the non-farm payrolls. A pretty low estimate there of 120,000, down from 254,000 last month. A lot of that's probably just since September was the high print, kind of making up for it with a lower print here for October. But it'll be interesting to see. I think if we get that 120, we'll see how the revisions come out. But if we kind of get that level, I don't think the market moves either direction. That's kind of the sweet spot, not too hot, not too cold. That's the Goldilocks scenario there. Unemployment rate expected to be at 4.1 continuous there. And the labor force participation rate, 62.7, was last month. So we will see where that shakes out. Underemployment, 7.7, similar story there. And so that should be a pretty busy week. Don't forget Halloween on Thursday. So that's always something to keep in mind. Markets tend to be a little bit shorter, close a little bit earlier, and be a little bit less fall at the end of the month as people leave a little bit early to get out with their little ones. I know I will be going out as a wizard this year. So with that, I'd like to wrap it up there, Mark. Unless you have any other comments or questions on next week's macro side.
I'll leave it there. I'm just going to close with a Go Dodgers. We start off with the World Series tonight, a little LA New York rivalry. So hope people out there enjoy it.
All right, sounds good. All right, thanks for everyone for listening. Don't forget to, or I guess that wraps it up for this week.
And yes, thanks to all our listeners out there today on DL Minutes. Hit us up on the X at DLine Minutes or send us an email at minutes@doubleline.com with any questions, comments, or suggestions.
Yeah, our YouTube channel is youtube.com/double line capital. You can, if you're listening to this on the YouTube, thank you. Don't forget to subscribe there at our at youtube.com/double line capital. Thanks for tuning in. Hope everyone has a great weekend.
Yeah, thanks and stay safe out there. Go Dodgers.